next guest says that the expectations going forward look pretty promising. How is the interest rate story here in Canada and in the US affecting these sectors? And why are they keeping a pretty close eye on how the US presidential election shakes out? Joining me here today to discuss the latest movements in industrials and the materials sectors are Fidelity Equity Research Analysts Robert Reynolds and Claire Fleming. Great to see you both. Welcome.
Thanks for having us.
Here.
It's a bit of a day in the equity markets, so we'll just sort of begin with inviting everyone to send their questions in over the next little while. There might be lots of them, but often it's a great buying opportunity if you can sort of look at it the right way. Do you want to just address, we're seeing a sell-off in markets, we're seeing vol pretty high. You're going to be looking at things that go further out, but could you see a buying opportunity here? We'll begin with you, Bobby.
Sure. So, I mean, we've been through days like this in the past a number of times and been with Fidelity for 6 years and in the industry for 11 years. And generally what I try to do on days like today, and I think what I try to help a number of PMs do, is lean into some of the opportunities that we like longer run, but that might be getting hit especially hard on shorter term economic concerns. Yeah. And hopefully you have a portfolio that might have some more defensive positions or some names that are holding back in, and those can be a source of funds today, depending on your view on where things are going. But sure, we try to look for where the opportunities are, where are things maybe indiscriminately getting sold due to what's happening in the market versus what's happening in the fundamentals of a company.
Yeah, Claire, do you want to add to that? You cover materials. We're going to dig into certain areas of that and the earnings story. But again, if you like what the stock represents, actually some of them are even up today. What do you think about today?
I think across my group, there's a lot of different commodities and sub-industries that I'm covering, but I'm spending more time on some of those groups that could be multi-year beneficiaries of interest rate cuts. Given how topical the rate cutting cycle has been, I think there's still questions around the exact pace of that. But with some of these companies, you see they've had a lot of challenges over the past few years and higher rates, and there's a potential for fundamentals to change. Like, for example, I think lumber is a great example with that, where, as you can imagine, how rates have put so much pressure on home building in the US. Demand's also been challenged from a normalization of all that repair and remodeling demand from COVID when people were doing more home projects, and that's finally starting to normalize. And they'd had a lot more supply coming on because of how high lumber prices got during that period. But now you're at a point where lower rates could potentially give you more visibility on demand a few years out. Companies are rationalizing a lot of supply in that industry to help bring things into balance. And these companies also, some of them have great balance sheets compared to past cycles. So that helps you be a bit earlier on some of those opportunities if you think that they have less debt compared to past cycles, and that might reduce some of the downside compared to past cycles.
That's fascinating. We'll come back to the balance sheet story for sure. Bobby, I might ask you, Claire brought up home builders, which I think you mentioned is not something that you're following, but you're following the industrials, which are often part of what's selling into the sort of consumer story, including home builders. Tell us a bit about the industrials overall, the macro backdrop, which is being shaken today, there's no question, but broadly what you're setting up for here.
So industrials, and in particular US industrials, have actually been a relatively strong performing sector over the last year and a half. A number of themes that could potentially benefit industrials, like nearshoring, the build out of data centers, and transport's probably on the weaker end of the industrial scale. Because
has that bottomed, do you think?
I think it likely has. You've been in a 2-year freight recession already. There was a huge spike in goods demand in 2021 in the COVID period, and you've had to work through a destocking over the last 2 years. Inventory levels are at relatively good positions. Pricing's already very weak in that sector, and so supply has been coming out of the market. Now, it's very difficult for these companies to do well fundamentally if end demand significantly deteriorates in a hard landing scenario. Yeah. But from an expectation standpoint, you're already coming from a point where people's expectations are lower relative to maybe where they are in other industrials that are derivative plays on the AI trade, as one example.
That's
and
really
so, we try to look for places where expectations don't line up with where we think things could go in the next year, because that can be where the opportunities are if that drives positive earnings revisions in the future.
Well, let's come into sort of the earnings, the guidance, what we've seen so far. I think you've mentioned that the second quarter can be a little bit of what the banks do with the fourth quarter, sort of the kitchen sink quarter a little bit, get things out of the way, get some revisions sorted out so that you can move forward. So with the idea of moving forward in mind, how have earnings been across the board? And really the guidance, I guess, is what we want to get to. Claire?
I think across my group, there haven't been too many surprises in guidance in terms of company-specific drivers, but where a lot of that volatility has come from over the past few months has been with some of the changes in economic indicators. So as coming up earlier, maybe I can use the copper group as an example. I think what's really changed since Q1 earnings were coming out and there's a lot more optimism is perhaps some of that policy and stimulus in China wasn't as strong as some people might have expected. We've seen a lot of data points related to US PMIs or even the unemployment numbers today being perhaps a bit more challenged than some people expected. And the US dollar's also been relatively strong, which can sometimes be challenging for commodities to outperform.
So we're seeing a little drop here today.
So there's been some challenges during this period, even if it's not as directly driven by company earnings. But I think there's some great differences this cycle compared to past cycles where you do still have some secular trends that can help offset some of those cyclical pressures on demand for copper. If you think of things like electric vehicles or renewables or grid-related spending that can help support demand. And as well, when I talked about lumber sheets or balance sheets for some of those lumber companies, similar in copper, I think some of the companies have really benefited from higher commodities over the past few years. And that can also help to reduce some of the downside compared to past cycles.
So just if we go into the rate cutting cycle, ultimately, it is also kind of delayed from the beginning of the year. So at the beginning of the year, we all know how many rate cuts were priced in. It was sort of astronomical and everyone was waiting. Is that just delayed and we might see sort of this uptick pretty soon? Because it looks like the Fed's going to have to do something for sure in September at this point.
I think it is difficult to know exactly what that pace looks like, but there are some companies across my group that would be beneficiaries, of course, of more visibility on rate cuts. As I mentioned earlier, the lumber group would be a beneficiary of that. The copper group as well, if you did get a level of cuts or stimulus that help give you visibility that there could be some more stability in some of those economic indicators that I mentioned earlier that have been creating some concerns about demand, then that would also benefit the group, of course with a lag, just to reflect the implementation for some of that policy.
Bobby, from your perspective, is a cut going to make things fly? I mean, that's sort of one of the questions, because we're watching what's happening without having a cut earlier this week.
Well, I mean, the federal funds rate's still over 5%, right? So I don't know if just one cut does it. The message that I've heard from companies reporting earnings so far in industrials, and perhaps again for this discussion on the economy, the freight companies are the most relevant since they have a real-time pulse of what's happening, is consumer freight is actually relatively resilient. Again, remember, consumer companies were destocking last year and the year before. Now they're in a healthy inventory position. So consumer freight's actually relatively strong because you're lapping that destock. It's the industrial freight where there's more signs of weakness. And you could think about stuff like heavy machinery, where there was a lot of demand for that over the last year or two due to infrastructure spending and the mega projects you hear about, and now supply has caught up, and maybe some of those companies were producing too much for the trend level of demand, and you see production cuts there. Even in the aerospace industry, which has been an area of strength, you see the challenges that the airplane producers are having. They're having to cut their production rates. There's a large derivative impact of that on the industrial economy in North America. And so it's the industrial side where there's been some incremental weakness, but the consumer-facing retail side has actually been not much change this quarter.
So what is your read on consumers going forward then? I mean, for the purposes of what you're doing.
So it's difficult to predict, but obviously we need to have a view as sector analysts. The US is in a better position than Canada still, and that's been the story for the last couple of years. You see that in the spending data. The US consumer real consumption is growing maybe a point a year faster than Canadian consumption, and that's with slower population growth in the US. So on a per person basis, the gap is even a couple points wider than that. And that's just they've locked in low interest rates. And here we've been facing these rate resets for the last couple of years, and we'll continue to face that headwind. And so even companies in the same industry like airlines, you see a divergence in performance between US and Canadian airlines because that consumer is in a better position to continue spending.
Interesting. So still sort of looking at the US growth story as it feeds into what we're talking about here today. Take us to the M&A story. There's been lots of headlines about tries, misses, some successful, particularly in the commodity. I mean, this has actually been going on for some time, but now we could be looking at a weaker US dollar. Again, hard to know where this all goes today in markets. Probably looking at an easing cycle. Take us into the M&A world.
M&A's still been really topical in the mining space, I think, especially over the past year. And part of what's driving that is because as it's become increasingly difficult to build a project with the capital intensity required, all the permitting and time needed to do that, the companies are starting to look more at M&A options, since that's sometimes a relatively less expensive way to grow, depending on the project. I think during these periods where there's been a lot more M&A news, it's been great having a global analyst team. So even though my coverage is more Canadian focused, we have colleagues in London and Australia covering some of those internationally listed miners whose names often come up in these M&A discussions. And it's been great to go back and forth with them about which companies seem to have more interest in M&A or discuss some of the valuations for transactions that we've been seeing and use that as an input to some of the scenario analysis that we'll do on companies. Given when periods of M&A pick up, just to understand what that potential upside could be in that type of a scenario.
So what is it and how much is it based on kind of policy at this point?
I think we have seen some headlines from the Canadian government that suggest that policy could play an impact on some of those M&A scenarios. It's still unclear exactly what those restrictions are or if there's conditions where Canadian companies could be acquired by foreign acquirers, or if there's conditions. So perhaps that's a bit of a barrier to full company takeouts in the near term, but I think you still maybe have the potential for some companies to look at asset level transactions or finding a partner or looking for monetizing an interest in an asset. Some companies have been fairly public about looking for those types of scenarios to help fund the rest of their business.
Yeah, fascinating. It's a really interesting time in that story. Is it as interesting for industrials? It looks like it.
Yeah, M&A is a big value driver for
really
a lot of industrial companies in Canada. We have some great multi-year compounders in the industrial space, whether you think about in the engineering sector, in the transportation sector, even in the information services sector. And so betting with companies that have strong balance sheets and have shown the ability to be opportunistic in M&A in the past, weak markets.
You're talking about the buyers
the
at
buyers.
this stage, rather
weak
than
markets
those being
are,
sold.
are good for buyers, not sellers.
For sure.
So generally the compounders have been the buyers over time, and the sellers can be more distressed assets. And I've already seen examples over the last year of companies in the transportation space taking advantage of distressed sellers to pick up high quality assets on the cheap. And that's something that I would expect to continue if markets continue their sell-off.
Right, fascinating. Labor disruptions, let's talk a little bit about that. We've heard a few headlines, this is more on the Canadian side of things. I might speak to you about that a bit. It's something I think for Bobby at this point, the labor disruption story. What do you think?
So there's a couple of relatively large stories going on that front. First, you've got the airline industry with a pilots negotiation underway. That's been relatively quiet, actually. It's sort of pushed that out beyond the peak summer travel season, but it's still an issue that will need to be addressed before the end of the year to see how that shakes out. Likely you see the pilots get a very significant wage increase and probably no strike, just given the disruption, but we don't know for sure. The other one's on with the Canadian railroads. And so their conductors and engineers union was likely going to go on strike in May. The Labour Minister intervened and asked the Industrial Relations Board in Canada to assess whether railroads should be considered an essential service. And we'll see what the outcome is of that. The industry is very confident that they're unlikely to get that designation, which actually they would prefer not to have because it could force them to operate suboptimally during labor negotiations and only move certain commodities. but that decision's expected August 9th, I believe.
Yeah.
And beyond that, you're likely to see some sort of strike or lockout. The consensus is the government will need to intervene because you would have both freight railroads and the dispatching services for commuter trains in Toronto, Montreal, and Vancouver on strike. So that would be extremely disruptive to the economy, probably almost very low odds of something like that happening.
Okay. Claire, across where you're covering specifically the materials, maybe commodities more broadly, but is labor an issue at this point?
I think sometimes when there's disruption in Bobby's sectors, he's talking about the rails, that can impact some of my group, given that especially in Western Canada, you think of things like forest products or fertilizers.
They're
a lot of those
pick
companies
up all those things,
rely on
not.
the rail in order to get their product out. So sometimes companies do have to look at alternate logistics during periods where there's disruption in the rails.
Yeah.
I do think more broadly on labor, though, we are starting to see generally a stabilization across my coverage group. Of course, there's still wage inflation, but compared to the period during COVID where availability was a really big issue, it was tough to find people to staff your lumber mill in Louisiana or your mine in a remote area, and there was a lot more wage inflation. I feel like that was really making it more difficult to have predictability on costs. I think at this point, of course, some markets are still tighter than others, but the availability of labor and wage inflation rates do start to be coming towards more normalized level, just given some of the softness in the labor market compared to the past couple of years.
Yeah, it's fascinating. And but we do hear sort of that normalization piece in other industries as well, gone through the bumps at this stage. So we'll keep an eye on that. Let's talk a little bit about the election in the US. To the extent that we can see anything, what would be good for each of your sectors, essentially? I mean, broadly in markets, you'll hear a lot of gridlock would be great, or perhaps a Republican sweep, or whatever. How does it shake out for you? How do you put this into everything that you're calculating for the next couple of years?
If you just look at the policies that the Republicans candidate has proposed, putting the trade aside, lower taxes, less regulation, generally positive for markets. The wrinkle is the trade rhetoric, which could have quite a negative impact on certain Canadian companies if you just take Trump at his word that he wants a 10% universal tariff. Now, we have the USMCA agreement. It was negotiated by Trump. I think the probability of a 10% universal tariff on Canadian trade with the US is quite low, but it's going to be used as a negotiating tactic. So there could be increased noise, in particular around Canadian exporters to the US, and that could be impacted by that policy. So
what happens during sort of the negotiation period where there is rhetoric, it gets played out sort of in the public sphere? Yeah. What do you notice in the stocks?
You can see weakness. That can be a buying opportunity if you have a strong view that the outcome is unlikely to be what's negatively priced into the market. But there are areas that they do want to address, and it's less so with Canada and more so with trade with Mexico, and also the use of Mexico as a conduit for Chinese imports to enter the US market on a tariff-free basis. And to me, that's the main piece that's actually likely to happen under, frankly, either US administration, but perhaps attacked by the Republicans quite a bit more. Just broadly, though, the odds of a Republican president were up to 70% at one point in the last month, and now I think the market's back to more of a 50-50 probability given what's happened in recent polling. And that's brought more uncertainty because the Democrats, you probably get a split Congress and Senate still in that scenario, so there's gridlock, but there's tax cuts that are expiring next year, which would be a headwind on...
Which are personal
tax cuts. It'd be a headwind for consumer spending if they aren't extended. And it's unclear if the Democrats want to extend them, the Republicans do. And so I think that's becomes more of a headwind and issue in a toss-up or in a Democratic president scenario.
And it backs up into the industrials, does it?
It does, in particular to companies that benefit from selling goods to higher income consumers, because the tax cuts actually disproportionately benefit the high income consumer in the US. And so those would be the more impacted companies.
Claire, for your purposes, for the companies that you're following, and probably a couple of comments broadly on commodities and materials, what are the two cases there, I guess, one way or the other? How do you trade the election or stay out of the way?
I can speak to some of the policy issues that could impact my group. I think similar to as Bobby mentioned, there was a big focus on understanding potential trade or tariff dynamics, just because in scenarios where you do have changes to tariffs, that can be challenging for goods demand across certain sectors, and that can impact demand for some of the commodities that I cover. I think some of the other two key areas of policy that I keep an eye on are related to, one is related to demand as well, in that any differences in infrastructure-related policies or the clean energy transition and types of support or funding of that can impact demand for companies in my group as well. And I think one area that can also impact the outlook for certain companies is just related to policy around mining. I think it's well known that getting all of the permits and getting funding for some companies that are in an early stage projects in the US can be challenging. And that's something that if you were to have a scenario where you ever got more visibility on that in terms of policy or access to funding, then that could benefit some of the companies with earlier stage projects in certain areas of the US.
Okay. It's a fascinating day for sort of the tech sector on the stock market. Certainly, there's certainly a rotation out of tech, out of lots of things. But let's talk a little bit about the data center story and how the whole AI build out essentially affects kind of the infrastructure potentially of North America and beyond, and your two groups in particular. Can you tell us a little bit about the companies that you follow and to what extent it looks like AI will be material to them?
So data center build out in the United States has been a real demand driver for a number of industrial companies, more so US industrials than Canadian. There are a couple of smaller caps in Canada that have benefited.
Do you expect that to shift?
So I expect the data center growth that you've seen in the US to also happen in Canada. Okay. One of the things I hear from companies that are using AI in their products, for example, legal research products, is there's concerns around data moving across borders, in particular, privileged client data. And so some clients want the data center to be situated in their own country. They don't want to send their information to a foreign country. To
be domiciled,
Yeah, so that can be a driver of domestic data center growth in markets outside of the United States. And that's a trend you hear the tech hardware companies talk about, nationalization of data. And so there are companies in Canada that could benefit from that growth, in particular in the engineering construction space. If you've got a lot of electricians in your workforce, these are very complex electrical projects to work on. They tend to be higher margin projects for these companies, and those are lower margin businesses. So they can be powerful earnings drivers. But as it pertains to the US, those stocks were some of the best performers. And as part of this unwind, people look at the other side and start to worry about the downside. They've been some of the hardest hit. Haven't seen that impact Canadian industrials as much, just given we don't have the same larger cap winners that you've had in US industrials.
Right, so the same demand isn't there, but it is.
I think it's
it'll
coming.
Be there.
Probably not to the same magnitude as the US, but there will be a ramp up. That's been the discussion amongst even real estate professionals that work in the data center vertical. It's just a little delayed.
Claire, how much of the story is just copper? Or is it bigger than just copper?
I do feel like a lot of it is copper related in terms of the implications for my group, and this has been interesting. I feel like I haven't interacted with the tech team too much in my time covering materials. But this is one area where we've worked to help develop a view on what the implications could be of that data center build on copper-related demand. Of course, the key implications are that as you build more data centers, you need more power to support those, and you also need all the cabling to integrate those into the grid, and that's the piece of it that's copper intensive. I do think, though, that some of the really elevated estimates that you sometimes hear for how much that could impact copper demand, though, might be underappreciating some of the potential changes in intensity levels. And that's because besides just copper, there are some other alternatives for cabling, like fiber optic cables. And they do tend to be more expensive than copper, but one of their advantages is speed, which is sometimes a benefit for companies that are looking for that.
So what are they made of? Fiber
optic cables, just a different material. Okay. And I think that's something that clearly you will still need more copper as that power infrastructure gets built, as that cabling gets built. But perhaps the fact that there's just some alternatives to copper for cabling that might help to just reduce the intensity somewhat compared to some estimates that might assume that most of that incremental demand is going to be almost entirely driven by copper.
Yeah, it sounds like it's become consensus. So then you probably want to poke at that a little bit. Okay, some great questions. And it looks like a question for each of you. When comparing these sectors with other countries and their own sectors within, do you see inefficiencies here? It's certainly going to be a different market. Bobby, do you want to tackle that first?
Inefficiencies in Canadian industrials versus other markets. There can be, in particular on the smaller cap scale, just given the, there's fewer eyeballs looking at smaller cap Canadian stocks than there are looking at industrial stocks in the US. I think we've got some of those opportunities in our portfolios today, where the example I gave on the data center build coming to Canada, I think there's companies in Canada that will benefit hugely from that are trading at significantly lower multiples than similar companies in the United States. And so there are some examples on the larger cap side, not as much. I think that they get enough eyeballs and attention to see that. It's more so small cap.
Okay, really interesting. Claire, what do you think?
I think in my group I sometimes do see those disconnects, because even though my companies are listed in Canada, a lot of their assets or where demand is coming from is from global markets. So I think that can sometimes create inefficiencies. I think the lumber group that I was talking about near the start of our discussion is one example of that, where a lot of the demand for these companies, even though they're listed in Canada, is going to be coming from US housing starts. Because these companies have diversified a lot over time, and a lot of them have assets in the US as well now. And I think there's been a big disconnect in the relative performance compared to some of the Canadian listed lumber companies compared to some of the other US listed companies that you see with exposure to the housing cycle, whether they're direct peers or in other areas of the value chain related to home building in the US. But I think that's an interesting example of where there's been a bit of a disconnect between some companies listed in different markets, but that are really exposed to the same key driver, being that US housing cycle and expectations for that.
And I think we'll have to leave it there. I've got more questions follow-up for you there. Is there just a quick final note on your industry going forward? You can look at a slightly longer horizon that you just want investors to kind of take home with them. Bobby?
Yeah, I'd say we're focused on where's the best opportunities over the next 1 to 2 years. And so in days like today and in weeks like this week, it's been a tough week for the market. We try to lean into the opportunities that we really like that might be getting overly punished. And we've got a very strong bench of analysts that have been through situations like this before. We work very well with our PMs, and we just try to lean into those opportunities so that we can make sure we deliver very strong returns through the market cycles.
Fantastic. Claire, just a final thought in the materials sector.
And I think similarly, it is helpful to emphasize on volatile days like today that having a full coverage model and having up-to-date models and views on all of these companies just helps us to find opportunities when there is volatility in the markets like this week. And I think that's a great advantage, especially in materials, where because a lot of these companies can be pretty volatile or smaller market cap, there's not always as much attention on them. And I think that having that full coverage helps us to respond faster.
Yeah. You do have full eyes on it. It's great.